And good afternoon. Welcome into another episode of Market Talk on this Wednesday, April 20th. Thank you so much for joining us and making us part of your day today. I'm your host, Jesse Allen. Find us online, markettalkag.com. All our streaming sources are there. All of our radio affiliates, the latest news of agriculture, social media, much more. It's all online, markettalkag.com. Well, we saw corn, soybeans, especially the soy complex, trade higher on the day Wednesday. That helped pull corn with it a little bit. While winter wheat broke, we have plenty to discuss. Here to help us do just that, let's bring in our good friend Mike Zuzolo with Global Commodity Analytics joining us here on this Wednesday afternoon. Mike, and good afternoon to you, sir. Looking at this trade today, quite a few interesting things of note. That soy complex, though, really kind of took off as the upside leader today and helped pull corn with it, even though we did see a little bit of spread trading in corn and soybeans, both between the old and new crop today.
Yeah, it seemed like we were poised, especially with some fresh numbers coming out of South America and bean production, and they're not really going up much from what the private guesses are and some of the official, non-official guesses down in South America, like Abiyev. They're coming out with, the 124s, 125s. And so I think that has helped, along with the fact that we're almost 90% harvested in Brazil at this point for soybeans, Jesse. And so we've got maybe a little bit on the supply side of underpinning the trade feeling like they priced it enough, especially you brought up the spreads. I mean, you look at that bean corn ratio, we're still down around mid 2021 levels for lead month bean corn ratios with an outside week now working higher. We made a lower in lead month beans earlier this week. Now we've made a higher high versus last week's high. And we're poised to try and test that old high from a couple weeks ago based upon what the charts look like right now. But that lead month bean corn ratio down there at 1 year lows roughly. The new crop bean corn ratio down at contract lows up until the midweek this week's trade. So the funds have been heavily short the beans, heavily long the corn. They were positioned to take profit at some point. What was the catalyst? It probably wasn't that supply issue that I was just talking about out of Brazil and the harvest progress. I really think it came back to China. China, in terms of their GDP, coming in at a plus 4.8% for Q1. That beat the trade estimates of about 4.5%. Probably more importantly is the idea that Q1 Chinese pork production came in at about 15.6 million tons. That was up about 14%. Similarly, about a day plus or minus from when we got that figure, we found out that Chinese imports of pork coming into their country for Q1 was down 64%. So I think the trade's putting together the idea that we've got a base of supply that is more known at this point, and we've got China's demand coming back in and supporting this more market. Obviously, the thing that has been supporting the soybeans throughout this whole roughly 2 quarters has been the crude oil market and the vegetable oil market. That has not let up at all at this point.
Well, plenty to take out of what you just all said there, Mike. And I think just to start, and this will help us segue into what we saw in wheat today. Let's talk weather and look at where things stand here. April 20th, a lot of farmers itchy to get in the fields, but it's been cool and wet for many areas. I'm going to pull up, you sent me a couple different things for the video feed. This is the precipitation totals for the next 7 days. And, we see quite a bit of red on the screen there through parts of Arkansas, Missouri into the eastern Corn Belt. That's going to be a worry moving forward, I think.
Yeah, it is. I think this is where the saturated areas of Illinois, Indiana, and northwestern Ohio are not going to catch a break if this model map is right. Where we may see a little bit of reprieve and a little bit more work going on next week, if this model's right, is the Kentucky, Tennessee areas. And those were the ones on the corn planting progress numbers that really showed up how bad it was in terms of the early start. The potential for really record-breaking yields like those two states have been able to carve out in recent years when they've been able to plant early. U.S. corn planting at 4% versus 8% last year. Big reason was those two states. They came in at 6 and 7% respectively. That compares to, I think, around a 26% versus last year or the 5-year average. I can't remember which, but it was a quarter of the way done, either last year or the 5-year average in those two states. But I think you're right, Jesse. I think this is where the trade is going to have a real difficult time with Illinois and Indiana and most of the Ohio corn ground staying very, very wet as we get into late April, because again, USDA has such a high national yield for the corn at this point of 181. Typically, you got to get it in early to be able to get those kind of big yields out of the production and out of the fields. The other thing goes back to is a lot of traders in Chicago felt as though the corn acres were bound to go higher since the March acreage survey report. That I think is being walked back quite a bit. I think it'll be walked back and traded back as we get into the last week of April, which is just around the corner. So this goes back to our bean commentary. My biggest question for the corn market and the bean market is, will the bean rally be short-lived, or will corn and wheat take over again and support the beans and let the beans take out those old highs? Because it seems like the beans are very, very rich again in terms of price, and up against those old highs. I would think that between the Chinese economy likely slowing down, even though that wasn't caught in those GDP figures, the corn versus bean acres issue, I think in new crop especially, I think the trade's going to have to address that at some point.
Well, I want to segue over to the wheat complex today. Winter wheat had broken lower wheat. We actually did come off the lows a bit at the close, but you look at on this map, you see some of those areas in Kansas where you're at, Oklahoma, parts of hard red winter wheat country where it's still fairly dry. But what did you see was the reasoning behind the break in the wheat market here today, Mike?
Yeah, great question. If I could give it just a one short answer, it's funds versus fundamentals, Jesse. And I say that because I've been tracking the volume and open interest in the soft red wheat, which is by far the heaviest traded complex of the wheat classes. So you've got this drought you're talking about in the southern plains we just saw. We just came off of a massive blizzard in the northern plains in North Dakota. They're 10 plus days behind at this point in terms of getting anything done in terms of spring wheat and durum. And so you're sitting here thinking to yourself, well, fundamentally, why are we going down in this market? Well, I think it's not the fundamentals. I really think it is the spread trade. And more importantly, I think it's the funds. I think the funds are out of position a little bit. They felt like they needed to wean down their positions on the soft red wheat because they were long. I say that because the volume and open interest numbers, since the high that we made back in terms of volume and open interest back on March 9th, March 8th, I think it was, we're down about 30% as of yesterday's trade on volume for soft red wheat futures, and our open interest is down almost 2%. That doesn't sound like much, but in open interest, that's a big decline. And obviously with volume, 30% on April 19th versus the volume of 70% more than that on March 8th. That means a lot to the trade too. Whenever I see that, I think it's mainly the funds that are repositioning, rejiggering their portfolios. And a lot of this, I think, has to do with these brand new highs that we made in the dollar earlier this week. I just think between the Russian ruble and the US dollar, that the funds feel like they're a little bit too long on the wheat. Having said that, I think they're going to have to come back in and buy those wheat contracts back if the hard red wheat leads this market higher, which I think it has that chance and that possibility.
Well, I know you sent me a couple other weather-related charts as well. I'm just going to pull this up. Looking at a pretty big hail threat there throughout hard red winter wheat country coming up here this week.
Yeah, I didn't double check this because this came out right after lunch, and this is a hail threat in Wichita, which is Sedgwick County. It's one of the top 3 counties for hard red wheat, and the top 3 counties in hard red wheat for Kansas are very, very easy to see. I mean, they're the top 3 by a long shot from what I've been able to look at and research over the last 9 years since I've been here. And so you're covering one of the biggest counties and part of another massive county if that hail comes in. I mean, that hail they're suggesting could be 2 inches or larger. And you notice Wichita is dealing with a situation where they're looking at massive sized hail based upon the dark purples and the almost white color scheme there. And so this is where, again, funds versus fundamentals. This thing came out at about 1 o'clock. Maybe that turned the hard red wheat around where we only closed down 4 or 5 cents. But this severe weather threat in this part of the country probably helped push the market down a little bit. But by the same token, you've got a lot of other fundamentals underneath you that should support this market more. So I just think the funds are trading this very, very short term, and they're not looking over their shoulder very much at all.
Yeah, and I know as well, just pulling this up real briefly, you also sent me, this is your location there in Kansas, just looking at that weather outlook again. Not to harp on the weather too much, but there's plenty of things to take into account with the hard red winter wheat belt here in the short term and moving forward, Mike?
Yeah, just the real brief thing on that is that's Hutchinson, Kansas. That's about 4 hours away from me. That's the heart of the wheat belt, and you're looking at less than a half an inch of rain for the next 14 days. And yeah, your temperatures are staying in the 70s, but I continue to hear from my clients in this state that April makes or breaks me in terms of the wheat crop, and even if it stays relatively cool, there's just not enough precip to keep the plants viable. So look at the conditions this week. I mean, that's what really made the trade second guess themselves Monday night when we saw conditions at 30%, good to excellent, the lowest since 1996. And so
Mhm.
I just think, again, the funds are probably positioning themselves in the wrong spot here unless we see a real big issue develop either in Russia in terms of peace breaking out or something in the currency markets.
We got our weekly ethanol report today, and oil numbers and gas and all that stuff. And just looking through what we saw here today, I'm going to pull up this chart, talk about what you saw on the energy side of things on Wednesday. Anything stand out to you?
Yeah, the big thing that stands out on this chart, it's hard to see it, but on the red line, we're down at 108 million barrels at this point for distillates. That's your diesel fuel. That's the lowest we've been since 2008. This week's numbers took us down below the 2013, 2014 time period and lows that we were hanging on to for the last several weeks. And so we're now down to the lowest level since 2008. Isn't it crazy how 2008 keeps coming back into these charts, and how we talk about that with the wheat market and the tightness of supplies? But I tell you, Jesse, after the weekly trade last week in crude oil, where we again made an outside week higher, we went down, took out the previous week's lows, came back up and made new highs, closed above the highs from the previous week. That outside week, some of the fundamentals that we're hearing about Russia pulling back on their crude oil production, OPEC saying they're not going to make up for it. I went ahead and recommended at the beginning of this week, when Midwest diesel and Midwest unleaded were both trading right around that 488 level a gallon, to go ahead and lock in 90 days of needs. May through July needs, I'm going to lock in here. I don't know if the futures market may continue to go lower, but I'm dubious to think that the cash market's going to follow it at this point, given we've got summer driving season and given we've got the airlines now not being forcing the mask issue and the mask mandate.
All right, I'm going to flip over to our final chart here today. And you mentioned GDP a couple times here today. Looking at the financial side, at talking GDP, walk us through this chart and explain a little bit more about what you've hit on a couple times here today.
Yeah, really good chart here to kind of sum up what we're talking about and why I'm hedging rallies, because I do feel like we're really eroding demand. And we talked about, as you say, Chinese demand, Chinese economic strength. You notice that what this is from the International Monetary Fund. They're having a massive meeting right now. This comes together with a big meeting on the food crisis, a lot being talked about and written about right now with the food crisis and the economy. So by one stage of the factor, you have the market saying we don't have enough energies supplies, we don't have enough food supplies. But by the same token, because of that, they're taking economic growth down. So we are rationing demand based upon this. And what this chart shows you is the IMF, just since January, has taken their 2022 GDP down by almost 1 full percentage point for the whole world. And you see on the right hand side, the blue dots is where they were in January, and the blue bar is where they're at currently. And we see that both the world, the advanced economies, and the Eastern European, Central Asian countries are all well below where they were expected to be in their new updates. And we also see that the commodity importing countries are the ones that are going to get hit as well. Only countries doing better, and this makes perfect sense to the farmer and to the analyst out there in the commodities, only countries doing better than what they were expected to do in January are the commodity exporting countries. But that doesn't give you enough upside in terms of economic growth to offset what the rest of the world's going to do. So we are rationing demand. We are likely going into a recession if we don't back these prices down and if we don't see these interest rates back down as well. And that's what I've been talking about a lot with you. And I'm still putting a recession on the table for the fourth quarter of this year. So hedge when these rallies come about. And I talked to a guy in north of Lafayette, Indiana today. He's getting almost $8.50 for cash corn right now.
Yeah, and that's something that I think farmers really have to take into account. Let's talk livestock here, Mike. Cattle strong day again today. We saw some good feedlot cash trade yesterday, a little more today. What's your thoughts with what you're seeing in cattle here as we work into the midweek?
I think it's pretty simple at this point. It's follow the money and follow the seasonals. We're coming off that Easter seasonal. We've got a CME hog index that's $12 cheaper than the new lead month May contract. So futures has got a massive premium in it. We're coming into a summer grilling season where beef is really being featured a lot more than I thought it would be at decent prices too, Jesse. And I think that's why the Packers came in. I heard that Nebraska was up $4 today or late yesterday at 145 bucks. That puts your dress price at 230. So these are the numbers that we really want to see. I think there's maybe another $1.50 up in the April fats. That's my overvalue level, that 144 area. That's where I'd be hedging pretty aggressively. And that 143, 142 and a half level in June fats, that's where I'm really looking to get some hedges in place there as well. But I think between the summer grilling seasonal and the end of the Easter seasonal, and the fact that June cattle got down to only about a $15 or $16 premium to the June hogs, all that adds up to me is kind of like the wheat. The funds are probably out of position here, too long in the hog sector, not long enough in the cattle.
Yeah, and on the hog sector, last couple of days, we pushed lower, a little bit of spread trading, even some of those very far deferred months trading a little bit higher compared to the front months right now. And I think that ties into what you mentioned, coming off that Easter seasonal and everything else. It's just kind of that point in time where we got to take a little bit off this hog market, maybe.
Yeah, and I wouldn't have a problem with the cash index and the May futures coming down and meeting each other halfway, coming in around 105, 106. That's still a really nice hog price to sell. One thing on the cattle we got to be careful of is the cattle on feed report coming out here at the end of the week. Placements, once again, are not expected to be high at all. The range is 87 to 96%, with the average trade guess of 92%. So we got to be careful, because I've noticed that I've been hearing anecdotally in the West, Western Nebraska, Western Kansas, a lot of cattle still moving into the lots because they're literally burning up out there. So 92% placements, I hope that's right, but I'm a little bit nervous that's too low. And if it came in at like 95%, I think maybe the feeders would have to set back. Have it if they do set back, I think that's your dip to buy as we get into like maybe the first week of May.
Well, Mike, a lot of stuff we covered today. Great as always. Any final thoughts you have for us before we run out of time?
Nope, that's it. Just go to globalcomresearch.com and sign up for a trial. And we've still got the special going for 3 months for $150. And you get a lot of information for that kind of money.
Globalcomresearch.com is where you can find it. With that, Mike Zuzolo, Global Commodity Analytics. Appreciate the time as always on this Wednesday, sir. Have a great week. We'll talk to you next week.
Thanks, Jesse. You have a great week, and thanks again for having me.
Appreciate it. Thank you very much. Mike Zuzolo, Global Commodity Analytics. That's going to do it for Market Talk on this Wednesday, April 20th. Find us, markettalkag.com. I'm Jesse Allen. Have a great afternoon.